Do I think the U.S. should have a recession now? I don't think so. One comprehensive measure is how much debt has been borrowed. U.S. companies have not borrowed a lot of money. It's been expensive too. And the debt that they have is low cost because they locked it in. U.S. households are under-levered. A measure is called the debt service ratio by the Federal Reserve. It's at roughly 10% of disposable income. Past recession peaks, meaning when leverage gets too high, it gets towards 14 or 16%. So consumers could borrow a lot of money. The only part of the economy that's over-levered is the U.S. government. But the U.S. government has never triggered a recession because they had too much debt. They could trigger a currency collapse, but not a recession.
To all the viewers in the United States, Korea, and around the world, welcome to Global Money Talk by SamProTV. I'm your host, Dan Ha. Our guest today is Tom Lee, Managing Partner and Head of Research at Fundstrat Global Advisors. Tom is known for his market calls. He is closely followed by institutions and individuals alike. When Tom speaks, people listen. It is my great pleasure to bring you this conversation with Tom Lee. Tom, thank you.
Great to be here.
So I'd like to start by asking you to please tell us a little bit about how you do what you do. And what I mean by that is the process by which you reach an investment conclusion. For example, to get a long-term S&P target, you project earnings per share out multiple years, throw on whatever you think the right appropriate multiple is, and that's how you can get long-term S&P target. But you also make short-term calls, like this month you think S&P might pull back 10%. So help us take a peek inside your mental framework, the things that you consider, the things that you synthesize, and get to these conclusions, both long-term conclusions and short-term conclusions.
That's a very involved answer because it really involves a lot of the first principles that we use at Fundstrat. But I'd say if I was to give you a more summary form, there's a lot of things we consider. One of the first things that we keep in the back of our minds is that the equity market is the junior piece of the capital structure, which means that stocks respond to economic data and to bonds and to risk, and therefore all of that ends up affecting how the stock market does. So we don't look at the stock market as the tail wagging the dog. It is the tail of the capital structure. And a second principle we always keep in the back of our minds is that consensus tends to be risk averse and crowded. So meaning what is a widely held view and might even be the most logical is probably also the most logical for most people, and therefore it's not actionable. So we try to think about where the variance or the surprise would occur relative to consensus. And often it makes you come to a counterintuitive conclusion. That process would make you bullish in the midst of a sell-off, and it would make you bearish at the top. The third thing that we always keep in the back of our minds is that there are longer-term drivers of markets, and I think the most underappreciated is demographics, that demographics are more important than even economic policy. And it's something I learned when I was a wireless analyst. Before I became a strategist in 2007, I'd spent the prior 14 years of my career as a technology analyst covering the wireless industry. And one of the things I learned was that the potential of the wireless industry was underestimated by most people because they didn't think about the demographic impact, that if 18-year-olds had a adoption rate of 100%, like you could see it in Korea in the early days, that meant that as they became 40 and 50-year-olds, the penetration rate of older adults would get to 100%. That means wireless would grow vastly over time because of this demographic impact. We found that the stock market really follows very closely the demographic cycles of people aged 30 to 50. And that's kept us bullish since 2009, because that's when that demographic actually bottomed. And the fourth principle we have is that you can't fight the Fed. So in 90% of the instances, when the Fed is dovish, you have to be bullish. And when the Fed is hawkish, you have to be bearish. But 2022 and 2023 was really the exception, because in late 2022, the Fed had to be hawkish optically, but actually they had turned dovish. That's the reason we had turned bullish and stayed bullish in 2023, because even though the Fed was explicitly hawkish, they were actually dovish. But I would say those four principles govern almost 80% of how we view markets.
Got it. As a sell-side analyst, a strategist, you have to put a number out. S&P 500, 6,000 by end of the year. But the reality is that the future, as we sit here today, is a range of possible outcomes. So how do you balance that when you advise your clients?
It is very tricky to actually have what we'd call a price target, because you're picking both a level for the markets and then a time frame. And so you're trying to get two things correct. And it's especially difficult knowing that there's really never equilibrium. It's not like the stock market cashes you out at the end of 2024, but we're still trying to figure out where the market level would end up being. Most people who follow and forecast markets tend to do what you just described, which is they give you 3 or 4 scenarios, and they'll say, well, there's a 20% chance this happens, and a 40% chance this happens, and a 20% chance this happens, and so my average target is this.
Right.
I think the flaw in that is that you're now trying to assign precision and probability to 3 different events, and I don't think our clients want that because it's confusing. So we tend to stick with a single number. And the way we develop that single number is everything you've described. We look at what could the PE be, what could the earnings power be, where could the surprise come from, how much will liquidity matter, and how much would risk appetite matter. And sometimes risk appetite is the most important thing, sometimes earnings. And then we actually have to use judgment to decide which one's the most important and come up with a single number. So I would say our targets aren't science, but it's where we're the most confident that that's the most probable path. And it's a process we've been doing since 2009, actually since 2008, and it's actually worked pretty well. I know when I was at JP Morgan, for the first 6 years, we had identified the closing price for the S&P 5 of the 6 years within 1%. Now, it's not that accurate anymore, but in the beginning, the process worked well for us.
Why is it not accurate anymore?
Well, we're directionally correct most of the time. But an example is, at the start of this year, we thought the S&P could get to 5,200. But that was, in December, 15% upside. But not only was the stock market strong in December, we always established the target in early December. Not only did last year, December 2023, the market rise a lot in December, but it was strong in the first half. So 5,200 won't work as a target, as a static target, because that's a 13-month target. But it's directionally correct, because at the time, 5,200 was the most bullish view.
Got it. As you mentioned, you started out as an equity research analyst, covering telecom and tech, then bankruptcies and small cap, then became a strategist. How have you evolved? Your process, your mental models, how you think about forecasting and risk, they must have evolved over time for you. And what were the pivotal moments in that evolution?
Well, I think a lot of life lessons that I live are actually life lessons for markets.
Okay.
I went to a business school undergraduate. I went to Wharton as an undergraduate and graduated, and my first job coming out of college was at Kidder Peabody, which was a stock research firm. And I was very fortunate to have been assigned. When you get a job in research, you don't pick the sector, but I was assigned to the wireless industry, which in the early 90s, it was in its infancy. There were only 34 million cell phones in the early 90s, and today there's 7 billion.
Right.
So you can imagine that that is a hyper-growth industry that has grown faster than even the internet. The few things I learned in wireless was, I think, pivotal to how I view markets. I mean, foremost, the wireless industry didn't generate money. The industry was always borrowing money. And so we had to develop a way to actually value the stocks, the equities, without earnings. And for most of my first, let's say, decade of that career, most people I met would say, Tom, the wireless industry is worth zero because they don't make money. But we'd always be like, well, what is the value of their subscribers or the spectrum they own, because they aren't capitalized on the balance sheet. And eventually they make money, but they have to spend marketing dollars to acquire the customers and build the networks. So it was really during that period that I learned a couple of things. One was that you can follow what the bond market is doing to know if there'll be moves in the stocks. So I learned to call our high yield desk every day and ask them the levels of different companies and were they trading better. And of course, if a bond started to trade well, then that meant that the bond market sensed something was improving, and therefore the stock would react. And so that was very helpful, and it really taught me to look at stocks as the junior piece of the capital structure. Whatever bonds are doing, stocks will follow.
Right.
Another thing I learned was how important the intangible value of an equity is, because in the wireless industry, they had to front load the cost of building the network and then acquiring a customer. So they didn't make money until 1 or 2 years later. And the wireless industry operated as what you'd call a long-term greedy business. They weren't trying to make money in the short term, but all the investment they were making created value in the future. I mean, that's today pretty widely accepted as the lifetime revenue of a customer, or we call it long-term greedy. And that's, a life lesson that you really shouldn't try to maximize how much money you make now. It's more important how much money you make over the cycle. And that's how we look at the equity markets. I think the third thing that really puzzled people was that when I was a wireless analyst, and I became pretty well known as a wireless analyst. In fact, I became institutional investor ranked only 2 years after starting coverage of the stocks, which made me, I know at Smith Barney, I was one of the youngest managing directors. I was 28 when I became a managing director there. And I was very, very fortunate to pick stocks almost at the bottom. And people always asked me, and so I had some very famous bottom calls. One was Western Wireless, which I upgraded at $1.76 the day of the low, and it was acquired by Alltel 18 months later for $40.
Wow.
And I upgraded Alamosa Holdings, which is a Sprint PCS affiliate, at 37 cents, and it got bought by Sprint for $22. So these were hundreds of times returns on investment for stock upgrades.
Right.
And people ask me, how am I picking bottoms in stocks? And what I have shared with my friends but never shared with my clients was that the stocks I would upgrade was based on me talking to all of my clients. And, at the time I might have 70 or 80 clients, so it wasn't hard to talk to everybody. And the ones that they were the most bearish on were the ones that I would upgrade. Okay. And the ones they were the most bullish on were the ones that I didn't think would work. And it's an example of how consensus gets crowded. So I use those same principles today when looking at markets. So, for instance, we found that when people panic about inflation, and I have a chart that we share with our clients, but it's happened 5 times since October 2022. When inflation expectations hit 4.3% 1 year forward, it has always marked a tactical low for the stock market because people get overly worried about inflation. So there's a lot of signal that still comes out of realizing what becomes crowded.
Got it. What was your worst call, and what did you learn from that?
Well, I've had many tough calls. I'd say the two that I always think about in the back of my mind, one was from 2004, and it was a long-running story arc, but in 2004, I turned negative on a wireless company called Nextel. And at the time, we were doing a lot of analysis of balance sheet quality and the quality of customers. And what we found was that we thought that this company's subscriber base wasn't as high quality as they claimed because of changing policies around churn and the way they capitalize certain items. And so we put a sell rating on the stock. And it became a very public battle with the management of that company because they viewed us as hostile to them, naturally, because we had a sell rating. And they were also a big investment banking client of the firm I was working at. So I was getting a lot of pressure to say favorable things about them. And a lot of my clients actually turned on us because they were angry that we weren't recommending a stock that they owned. But so we stuck with our negative rating. Eventually, the company was acquired by another company, and it turns out many of the things that we thought were quality issues basically came to light, and the acquirer almost imploded because of that. So in the years afterwards, so many of my hedge fund clients said, Tom, you nailed that call. I can't believe that you saw these things before anyone else did. Yet, to me, it was a huge loss because we had so much damage to our relationships. You know, people were they hated us for years that we didn't recommend a stock that they owned, that I was like, like having a sell rating, it's tough because you end up making enemies, and if you're right, they're not going to say thanks because they lost money on the stock. So I learned that it's very tough for investors to accept this idea that someone's trying to make you money. Like, our business is to try to make our clients money. We're not trying to be right. So that, to me, was very eye-opening. And I'd say that the second thing that sticks in my mind as being wrong, and we've been wrong a lot. We're going to be wrong a lot just because you can't get every call right.
Sure.
But I would say that it was really early 2022 that I regret not paying more attention to Mark Newton, who is our technician. So at my company, we have different silos of expertise. So I do macro research, which is fundamental analysis. We have Mark Newton, who does technical research, and he does cycle work, and it's very involved. He looks at so many different chart type models, whether it's DeMarks or stochastics or Fibonacci's or even other longer term cycles, liquidity cycles. We have a policy strategist and we have a crypto strategist named Sean Farrell. Well, in 2022, Mark had warned me. He's like, Tom, the market has gotten really weak. So at the start of 2020, he said, it is a really thin market and it's very tenuous. And so he thought we would be down more than 10% in the first half. And we were cautious in the first half of 2022, but we thought if you were down 10, you'd buy that. But he was adamant. And of course, we fell more than 10%, and Mark was still bearish. And he turned less bearish around August of 2022, which was the market's internal bottom. So that really taught me, and this only happened a couple years ago, that, liquidity and technicals, they can be so variant from what is common perception that you have to pay attention. So, subsequent to that, Mark and I work really closely. And I was like, Mark, you got to warn me. Next time you think there's a big drawdown coming, we should spend a lot of time figuring that out. And so, of course, that's what we do.
Got it. Your transition from a fundamental equity analyst to a strategist obviously couldn't have happened overnight. I mean, you may have gotten a new job, therefore you can say it happened overnight, but the way you think about investing, markets, and forecasting could not have happened overnight. So can you share a bit about that transition?
I think it's actually been one of the strengths that we've had doing macro research is that we come from a stock picking, bottoms-up research world.
Right.
Most equity strategists are macro people that are economists. And then they may follow economic data, but then they build what I would say is a stylized model of the economy and the stock market using indicators. They might say, I'm using PMIs or, liquidity or earnings. But we approach the world at Fundstrat more as the stock market is the composite results of the 500 names in the S&P. So I always think of it as these are individual companies that comprise the index. And the reason that evolution came for us was that when I was doing wireless, I had to do quite a lot of thematic work because it was a new industry. Many of my clients never heard of wireless, and there was also a very big age difference. Most people who manage money are in their 40s or 50s. Wireless was a new technology, and I was in my 20s at the time.
Right.
And I quickly learned young people adopt technology which most investors don't understand and they're skeptical of. And I witnessed it. We've witnessed it many times since, whether it's social media and how people have dismissed Google and Facebook, or how people have missed crypto, or even how people missed AI. A lot of people were dismissing AI just 2 years ago, saying it's not going to work. People are too optimistic, and look at AI now. So I've learned to look at the world through younger people's eyes. And so much of the work I did as a technology analyst was thematic, large think pieces I would publish. And I was at JP Morgan at the time, and they found it as the work I did was helpful to teach other analysts. So they had asked me to become the mid-cap strategist in around 2006 or so. Around that time, JP Morgan opened up a new research office in India, which was underutilized. It had 40 analysts. And so one of the projects I thought of doing was to look at bankruptcies, because wireless companies were going bankrupt. And so I sort of put this task list together to go through over, I think, 4,000 or 5,000 bankruptcies since 1970 to follow what happened to these companies. And it turns out that many of these companies that come out of bankruptcy come out much stronger. And so we wrote a book called, or a white paper called Chapter After Chapter 11, which became very popular, but it was basically recommending certain stocks as they came out of bankruptcy. So I was a mid-cap strategist for a while, doing bankruptcy research and wireless. And then in 2007, they asked me if I wanted to take on the larger role as the head of macro strategy. And that's when I started to do it. And sorry, it's for a long-winded answer, but at the time I was doubtful I should do it because I still viewed myself as someone who looks at 10 Qs and picks stocks.
Right.
And I didn't think anybody could actually forecast the stock market itself. But what I said was I would study it, and I did, and I came up with our own approach, which included those first principles I mentioned. And we started to write about the stock market in that way, which was very different than most strategists. Because most strategists will be like, oh, the ISM's at 45, which implies S&P earnings growth of X, and then you just throw a PE on it, and that's where the target is. And I could never believe that would actually work. So we come up with a very different approach. As we view this as stocks, what stocks could lead, and then how does that drive the value of the index?
Got it. So speaking of that, your S&P 500 target, whether it's the near term, 6,000 by year end or 15,000 by 2030, it comprises multiple assumptions. What are the key assumptions, and which of those assumptions do you have the least confidence in?
I might answer that by explaining that a mistake most people make is putting too much credence and weight on PE. Okay, so in other words, when people talk about the stock market, you'll hear a lot of experts say, oh, well, the PE should only be 18 times or 15 times this earnings, and therefore the stock is a sell.
Right.
I never understood it because, number one, in Wharton, when I took all my classes on finance, no one ever actually said PE was something tangible. PE is a residual calculation.
Right.
You have the price of a stock, and then you have a fundamental metric. Now, it could be earnings per share, it could be cash flow per share. What we never know is the reality is which earnings period are we looking at? Are we looking at last year's earnings or earnings 2 years from now or 20 years from now or next quarter? Are we more caring about cash flow or earnings or EBITDA? And then what's the right risk appetite? Because a PE in a world of 10% inflation is different than a PE in a 2% world. A PE is different if there's high cost of money or high risk aversion. So I always view PE as a residual calculation and actually not that important. And so when we think about where markets can go, we tend to think of it as how much we do stick with an earnings concept. We need to know what earnings power is.
Right.
But we're not anchored by it because earnings delivery can change because of concurrency, labor cost, margins, government policy, buybacks. So we think of earnings as sort of a base case. And then we sensitize it and ask, could earnings do better than expected or worse? And then we think about what that would mean to the PE. So we're not as anchored to the idea that, oh, hey, the forward earnings of the S&P is at 19 times, which it is today, the index, so it's a sell. Or someone will say small caps, PE is 24 times, so it's a sell. The reason I don't like that concept is that, one, there isn't really S&P earnings per share. It's the earnings of all these companies. And in the S&P today, for instance, the Mag 7 trade at 29 times earnings. So it makes the market look expensive. The median PE in the S&P is 17 times forward earnings.
Right.
And that's not at equilibrium. It's a moving target because earnings could do better or worse. The median PE in the Russell 2000 is 11 times. Now, over 30% of the Russell 2000 doesn't make money, but the vast majority of those that don't make money are biotech companies, and then there's a lot of regional banks, but regional banks are doing poorly because of monetary policy. So I'm not as constrained about what the Russell PE should be because I think the earnings could move a lot more in the next couple of years.
Got it. The economy hasn't had a broad-based recession since 2020, and arguably since 2009, depending on how one considers the 2020 COVID recession. But there's been pockets of recessions, whether it be durable goods, housing, unprofitable tech, or early stage venture, M&A, IPOs, and even crypto. Minus the major ones. A lot of the ones that probably should have never existed have all crashed. Is that it? Meaning that's the recession that we were supposed to get this time around, a collection of isolated recessions?
In a way, what you're describing are rolling recessions, right? Because pockets of the economy are contracting, but it's not large enough to cause the entire economy to be in a contraction cycle.
Right.
I think business cycles are very mysterious. I mean, if you use the NBER's dating system for recessions, and from 40 to 1990, economies were really frequent. In fact, the U.S. probably spent close to 40% of the time, 30 to 40% in recession. So in other words, in 10 years, you have 4 of those years are a recession. I mean, which is a lot of the time. Mm-hmm. But it made sense. Back then, manufacturing, which is super cyclical, was a large part of the economy. And as you know, there's the bullwhip effect around manufacturing, which leads to over-ordering and busts. So the economy, U.S. economy, was a boom-bust because manufacturing was such a big part of the business cycle. Since the 80s and 90s, the U.S. economy has evolved, and globally it's evolved. First, it's because the service economy has grown. Now, service is an encompassing word. It means healthcare, financial services, tech, transportation. Mm-hmm. But the service economy itself is less cyclical. It's steadier.
Right.
And government spending has become a larger share. So manufacturing, which has gone from being the largest share of the economy, is now arguably the smallest share.
Right.
And therefore, we should have fewer business cycles, which has actually been the case. Now, that business cycle volatility has been pushed to other countries, which do more manufacturing. That's why Asia is more of a boom-bust economy. And believe it or not, Europe is primarily a manufacturing economy. You know, Germany itself is one large manufacturer. And so Germany and Japan and Asia spend twice as much time in recession as the U.S. So the U.S. is essentially a consumer economy with a huge amount of accumulated wealth. The household net worth in the U.S. today is about $150 trillion. Let me just put that in perspective. The U.S. GDP is $25 trillion. So U.S. households have saved or have a net worth that is roughly 6 to 7 times the U.S. economy.
Right.
We could shut down the entire U.S. economy and we'd still have GDP because the U.S. consumer has $150 trillion of wealth. That is by a country mile. We are the wealthiest. The U.S. is the wealthiest nation. And I think that's why the business cycle is less tied to economic activity and maybe even more sensitive to the stock market. So the trade-off is, of course, the stock market has a psychological impact on the economy. So if we have a stock market crash, we're almost guaranteed to have a recession. Other countries could have a stock market crash, and it wouldn't affect their economy because very few people own equities. So that's, I think for someone who's looking at the U.S., that's something to keep in mind. And do I think the U.S. should have a recession now? I don't think so. You know, one comprehensive measure is how much debt has been borrowed. U.S. companies have not borrowed a lot of money. It's been expensive too, and the debt that they have is low cost because they locked it in. U.S. households are underlevered. A measure is called the debt service ratio by the Federal Reserve. It's at roughly 10% of disposable income. Past recession peaks, meaning when leverage gets too high, it gets towards 14 or 16%. So consumers could borrow a lot of money. The only part of the economy that's over-levered is the U.S. government. But the U.S. government has never triggered a recession because they had too much debt. They could trigger a currency collapse, but not a recession.
So speaking of household wealth and borrowing, asset prices of various kinds, whether it be stock market, gold, Bitcoin, home prices, are at or near records, which means that wealth is at or near records currently. And the Fed is about to make borrowing cheaper, or it's already started to do that. Why wouldn't this reignite inflation?
I think that there is not a direct relationship between asset prices and inflation. Many people think there is, and there logically should be. But we know many instances in many countries where you've had asset prices rise and it has not triggered inflation. In fact, you might even have some countries that are suffering from deflation. Inflation, which is a mysterious phenomenon, is best traced to, I think, in the Fed is acknowledges, to a change in how consumers and businesses expect price changes to take place. So if a consumer owns a lot of stocks and it's gone up, it doesn't mean that they expect the price of a car to go up or the price of a house. House and the car, by the way, is 60% of the CPI basket. So if those aren't going up, then is it hotels, restaurants, clothing? These aren't necessarily tied to stock prices. They are tied to wealth and spending ability, but the flip of that is the stock market isn't held by everybody. You know, most of the wealth of the stock market is held by a small percentage of households. So asset prices making new highs is not the sign of a top. In fact, in a bull market, you'll be making new highs all the time. You know what I mean? Like,
Right.
if you're in a bull market for stocks, it's always going to make a new high. So you can't say it's topping. I would say, to me, when the last stock that should never have a high multiple gets a high multiple is really when you get a top. And, when I see financials trading at 10 times earnings, a lot of staples have derated. I mean, small caps at 10 times earnings, I'm not sure it's a top.
Speaking of high multiples, Goldman recently made a prediction that the S&P 500 would return 3% a year for the next 10 years, citing, among other things, near record CAPE, cyclically adjusted PE, and concentration in the index. The call itself, the prediction itself is an opinion, but the CAPE and the concentration being near records, these are observable facts. You're long-term bullish. How do you take the same facts and get to a long-term bullish conclusion?
Well, I haven't seen the Goldman report, and so I can't speak to how they got to their conclusion. I won't doubt that they have done some work and they can show some charts. But I would just point out that cyclically adjusted PE, if we look at the chart, you would have actually sold the S&P already in 2014. So you would have been out of the market for the last 10 years because you revisited all-time highs in CAPE. So my guess is that someone who did this analysis in 2014 at an all-time high CAPE would say the next decade would have subpar returns, and the S&P has been 13% a year.
Right.
Second, I think that's another example of what I would call someone doing high-level analysis to explain stocks. Does this analysis capture the impact for AI? Does it capture the changes that could come with onshoring, with the changes in government policy around cost of energy? Does it capture demographics? None of those are reflected in a CAPE, and none are reflected in concentration. So I'd almost say that someone who would lend credence to that view is giving up all the discipline about equity investing in the first place. I mean, just as an observable fact.
Right.
That would be like someone saying, Tom, forget everything you know about investing and just look at one metric. But here's another intuitive way to look at it. If someone says the market's going to grow 3% a year, well, what will earnings do? Are earnings going to grow? Well, let's say GDP is 3 real, so that's nominal of 6 plus buybacks, so you have 9% earnings growth. So are they saying PE would contract 6% a year? So the PE is at 17 times now? Well, in 10 years, the PE would be down by 70%. So they're saying the PE goes from 17 to 10. Okay, so if PE goes to 10 and earnings grow at 9, we'll have 3% total return. But is that a reasonable base case? I mean, I don't know.
What about the concentration piece? That in order for the S&P 500, the cap-weighted S&P 500, to deliver strong returns over the long term, the top companies need to deliver high rates of return, the stocks.
It's actually not true. If you look at every 10-year period, 40% of the S&P return comes from companies that were not part of the index at the start of that period.
Right. So
10 years from now, only 60% of the index will be the same. 40% are completely new companies. Are these 40% going to deliver worse earnings growth? I mean, I'd be skeptical. Secondly, when people talk about concentration, the largest stock in many countries is often 27% of the index, whether you're looking at the UK, France, Germany. You look at most Asian countries, typically the largest stock is over 20% of the index. The largest stock in the US is 7 or 8%. I mean, we don't really have the concentration other countries have.
Right. What is an idea of yours that is most overlooked? In other words, that one pitch that you just can't get enough people to pay attention to.
Well, there's two kinds of skepticism. The one that we get the pushback on consistently is Bitcoin, because we've recommended at least a 2% allocation to crypto for 8 years now. That original recommendation would now be 40% of their portfolio without rebalance. If they owned a little bit of Ethereum, it'd be 80%. But today we still get people telling us, well, Bitcoin doesn't do anything. But it's gone from 1,000 to 72,000. The second thing that we get pushback is the idea that people in general think of us, if something isn't working now, it'll never work. And that is small caps. I think small caps could really be the star of the next decade. And it's because they've derated so much, but these aren't bad businesses, and they're under-owned today. And in fact, people are so liquidity-centric that they tend to avoid them. So I think there's a big opportunity in small caps.
Well, we'll have to leave it there. Tom, thank you very much.
Great, thank you. Trump is one of the most market-friendly presidents ever, meaning he's going to focus very much based on how the stock market does. It would still be less than the value of gold today. And I think Bitcoin will surpass the value of gold. Today, we're recommending at least 2 to 5% into Bitcoin. If they invest 2 to 5% of their money and somehow crypto goes to zero, they didn't lose everything. But if Bitcoin reaches some of the targets we expect, then Bitcoin could end up becoming 50% of their portfolio again. But I'm not recommending any specific tokens or cryptocurrencies along that line. There is so much money saved by the boomers. If the stock market goes up 20%, well, they just made 30 trillion, okay? I think Trump wants American businesses to make a lot of money so the stock market goes up.
Today, we're very, very happy to have Tom Lee, who's a long-time Wall Street strategist, has the founder of the company Fundstrat. He's frequently quoted on TV, has very, very interesting insights, and I'm really looking forward to our conversation here. Given the results of the election and what we know so far about the cabinet picks, what is your view on how the markets look and what they might be in the next 6 months for 2025 in terms of equities, in terms of bond yields, crypto, as well as commodities, if you take those in turn?
Trump is one of the most market-friendly presidents ever, meaning he's going to focus very much on and rate his presidency based on how the stock market does. And so that's good for investors, because if he introduces policies that worry markets, like deficits too big or tariffs too aggressive, he'll see it in the stock prices. I think the safest way to navigate this from our perspective is to focus on things that we all agree he'll pursue. Deregulation, pro-business and market-friendly, which means financials and small caps, but he does want to make the government more efficient and even do tariffs. So I think multinationals are a little more challenging, and industrials like defense would be challenging, and of course negative for healthcare and energy. From a bond market perspective, I think interest rates are initially rising because of concerns about deficit spending. But again, that's negative for stocks. So I don't think Trump nor his advisors want interest rates to go up dramatically. So I don't think interest rates are going to be the reason stocks underperform. And then from a crypto perspective, it's clear to me that he's pursuing a very pro-digital assets platform. I mean, he ran on the idea of Bitcoin potentially becoming a reserve asset. Almost all of his key advisors are large owners of Bitcoin. So I think Bitcoin is going to be very central to the White House initiatives over the next 4 years, which of course is positive for Bitcoin.
I want to talk about equities a little bit more. As you say, quite rightly, he measures his success by how the stock market is doing. How close do you think that reaction function will be? Will he do it ahead of time? Will his advisors tell him that if you cut taxes by too much, it's going to make the market concerned that the deficits are too high and therefore stocks will go down? Do you think that the market will sort of regulate Donald Trump in a way, in a strong way, so he doesn't do anything that's perhaps too wild?
too early to know how this relationship will work. I think that's the mistake investors make, is trying to think of the market in a very simplistic way. To me, over the next 4 years, there is a White House put. If the stock market starts to fall, this is going to drive some action or communication from the White House. As you know, whenever there's been a Fed put, when the Fed is dovish, then investors are confident buying stocks regardless of circumstances because they know the Fed is protecting the stock market. Over the next 4 years, we might have both a White House put and a Fed put. I think that's very positive for stocks. I wouldn't overthink it.
No, I'd have to say this is the first time I've heard someone say White House put. So if you ever hear it from anywhere else, you heard it here first from Tom Lee. I know the Federal Reserve has said, a certain Chair Powell has said many times that the Fed is apolitical. I do think they try to be that way, but in truth, the story might be a little different. Do you think that Trump's election and the fact that he will have a Republican Congress has changed the Fed's thinking? Could that be part of why Chair Powell said what he said on Wednesday, which what the market was not expecting?
The Federal Reserve is designed to be an independent entity, and it's important for markets to believe the Fed is independent. But every president has tried to influence the Fed. It's not just Trump. Famously, LBJ tried to influence policymakers. I know Greenspan faced a lot of pressure. Every Fed chair has been pressured by the White House because the Fed controls the economy. So without question, the Fed's goal is to ensure employment is full and inflation is low. Those kind of align with what any White House wants to do, but the timing isn't always the same. I think ultimately the Fed needs to push back and sound independent, but I don't think the Fed and the White House are opposing each other.
There's been, over the weekend, certainly some stories about two camps fighting on who should be appointed Treasury Secretary. So a two-part question. One is, how important is the Treasury Secretary for this administration? And do you have a sense of who they might appoint?
The Treasury Secretary is a very important role from a market's perspective, because the Treasury Secretary plays a role in not only issuance, so really the path of interest rates, but also foreign currencies, what the dollar does, and intervention during emergencies. We all know during the GFC, Paulson really was one of the key people. He was Treasury Secretary at the time that saved the economy. So it's a very important role. When we look at the 3 or 4 candidates that are leading, from Bessent to Lutnick to Warsh and Mark Rowan, all 4 will be very sophisticated investors. So I don't think markets are going to have problems with whoever they end up picking. But we don't know what criteria Trump is going to use. Is it going to be something based on market acceptance, and he can follow the betting markets to see where that stands? Or is it going to be something superficial? Because as you know, he didn't necessarily approve of Janet Yellen because he thought she was too short to be Fed chair.
Switch to Bitcoin. You've been on the record as being a very strong Bitcoin bull with a 1 year and 5 year forecast. If you would like to tell the audience what you're thinking they might be and why you feel so strongly about Bitcoin.
To us, Bitcoin represents one of the most trusted assets in the world, because we're living in a digital age where AI and cybersecurity threats have really undermined trust in both dealing with each other, but also in financial institutions. The Bitcoin blockchain is still the most secure ledger in the world. It has not had a single hack in its 14-year history. And that means the price of Bitcoin represents the value of trust in a trustless world. We've been recommending Bitcoin for 8 or 9 years, and it remains, in our view, a core asset. If we look at the price performance of Bitcoin, and we do have to look at price because it's a measure of its trust, it's following very closely previous halving cycles. and that implies Bitcoin should be around 100 to 150,000 in the near term, but could easily get close to 500,000 in 5 years. At 500,000 per Bitcoin, it would still be less than the value of gold today. And I think Bitcoin will surpass the value of gold, which would put the value much closer to $1 million per Bitcoin.
Is there at any point you would take profit on Bitcoin in the near or medium term?
I think Bitcoin is something you don't want to own if you believe there's another way to measure trust. I think that's many years away because even the United States may potentially own Bitcoin as a reserve asset. That is a huge endorsement of the security of the Bitcoin blockchain.
In terms of the other coins, are you as bullish? Anything that other than Bitcoin that you're as bullish? Ether or Solana, some of the other bigger coins?
We've followed crypto for 7-8 years now, and we've seen many what they call altcoins come and go. I think the most important thing to think about if you're going to buy altcoins is, number one, if you're investing in an altcoin, you should measure how useful that token is or the size of the community. By that measure, Ethereum and Solana look like very credible blockchains, layer 1 blockchains. But the second thing to keep in mind is that when crypto is in what they call crypto season, when it's in a bullish cycle, the altcoins do very well. So if Bitcoin can go from 90,000 to 500,000, many altcoins will do better, but those are not investments, those are trades.
For many years, the idea for investors was the 60-40, 60% equities, 40% bonds. If you're young, maybe you're a little more equities and a little less on bonds. What do you think that percentage ought to be? And at the same time, what do you think your Bitcoin percentage ought to be in sort of a model portfolio?
I generally don't try to advise people on allocation because how much someone puts into bonds, and bonds are less risky, depends on their tolerance for risk and their age, and also how much money is in the stock market versus their total net worth. So those are 3 variables that I don't know, and that's why we don't usually advise an allocation mix. But I can say that we've recommended initially, when we first wrote about Bitcoin, that investors put 1% into Bitcoin. And if they didn't sell that Bitcoin, even with the stock market gains, it's now 40% of their portfolio. And if our second suggestion was 0.5% into Bitcoin and 0.5% into Ethereum, and that is now 80% if they didn't rebalance. Today, we're recommending at least 2 to 5% into Bitcoin, but that is as a commodity or alternative exposure. Because if they invest 2 to 5% of their money and somehow crypto goes to zero, they didn't lose everything. But if Bitcoin reaches some of the targets we expect, then Bitcoin could end up becoming 50% of their portfolio again.
Switching gears a little bit, over time you've talked about how important demographics were to some of your economic calls and that they're very, very important. And we've just had, I think, about almost $1 trillion going to ETFs this year. I want to talk about the baby boomers. Oldest baby boomer is now probably about 80. The youngest is about 60, so average about 70 years old. Do you think that they would start taking money out of the market, a net withdrawals from the market rather than sort of adding money in? And will that have a substantial impact on the markets as the biggest, perhaps, demographic group is starting to pull money out on a net basis?
There are many people who are bearish because they say baby boomers are going to take money out of the stock market as they retire. And as you pointed out, baby boomers have been doing this for 8 years. Actually close to 28 years if you take the oldest boomer. And if we look at the last 28 years, the stock market has gone up. The reason it's gone up is that the baby boomers control over $120 billion of household net worth. The interest income from that is close to $7 billion a year. Sorry, 7 trillion a year. It's 120 trillion and 7 trillion. I may have used the wrong numbers. The US GDP is 25 trillion. There is so much money saved by the boomers. If the stock market goes up 20%, well, they just made 30 trillion, okay? They're not going to consume their savings. That's a very big misconception. In fact, as you know, household net worth in the last 28 years has exploded. So the boomers are spending a lot of money and living very well, and that's helping the economy, but there's still a lot of money left. And that's going to be transferred to millennials over the next 20 years. There's many people who can model this simply, but the median estimate is roughly 80 to 100 trillion will be transferred to millennials over the next 20 years. The average millennial will be somewhere between 35 and 45 when they receive this money, and that's going to be very stimulative not only for the economy, but will also be stimulative to equities because they're more likely to own stocks than a boomer.
About when do you think the bulk of this transfer is going to take place, or is it sort of in the process of happening right now?
I don't know if someone should try to model that precisely because we don't know what the mortality is going to be and we don't know the composition of portfolios. But if someone were to just make a simple observation, for the last 15 years, every single bear has told me the same thing that you just said. Baby boomers are retiring. It's a headwind for the economy. It's going to be a headwind for stocks because they're withdrawing money. And if they acted upon that, they missed out on 15 years of prodigious stock gains. So that would be my answer.
So your company FundStrat has just started a new ETF. It's called the Granny Shots ETF. I love the name. Can you tell us a little bit about the name and the ETF?
The Granny Shots ETF has an unusual name because someone will say, what is a granny shot? It's a basketball term. When someone throws a free throw, most people do an overhanded free throw. And that's because that looks cool. But the correct way to throw a free throw is a granny shot, which is underhanded. That is, based on physics, the best probable way to make a free throw. Rick Barry is an NBA Hall of Famer, made 90% of his free throw shots doing a granny shot. When it comes to investing, we created an ETF that is essentially a granny shot for stocks, which means we are trying to take the most probabilistic way to help you find winning stocks. It's based on finding thematic ideas. We have 7 themes that we think are the most important themes for stocks over the next decade. Keep in mind, famous hedge fund managers like Stan Druckenmiller said that 70 to 80% of the return in his portfolio comes from his macro choices, meaning thematic investing. The other 20% comes from stock selection. So we create a granny shot by taking these 7 important themes, identifying the most important stocks for each theme, and if a stock is in more than one theme, it's a granny shot, because now you have more than one way to actually find a winning idea. That's a portfolio that we've been providing to our research customers since 2019, and that was called Granny Shots. Every year since 2019, that research portfolio outperformed the S&P 500. In fact, even this year, that Granny Shots portfolio was outperforming the S&P 500 in a year when the S&P is up 25%. So we have moved that now completely into the ETF. And so the only way to own those ideas is to buy the FundStrat Capital ETF. We don't make specific recommendations for any tokens outside of Bitcoin, Ethereum, or Solana, but I don't mind commenting on those. When you ask about the idea of real assets backing a cryptocurrency, that's what they would call a tokenization of private assets. That's got a real future. That's what many banks are exploring, whether it's tokenizing a bond or real estate holdings or art or commodities, because it's removing a lot of the friction that exists in the financial system today. buying real estate, for instance, usually involves hundreds of documents and lawyers to verify information that could easily just be retrieved from the blockchain. But I'm not recommending any specific tokens or cryptocurrencies along that line. These crypto assets are not going to compete with Bitcoin, just in the same way that crypto is not competing for the US dollar. The US dollar today is still the most widely used currency to quote any price in any market, whether it's oil or housing or stocks or leather goods or luxury goods. In the crypto world, the most popular stable coin is quoted in USD, whether it's Tether or USDC, etc. Dollar dominance is very strong in the crypto world, which means if you ask me in the future, what are the dominant currencies? It's going to be Bitcoin and dollar. Currencies are very hard to predict. I don't think the White House or the Fed or investors can predict the direction of a currency. If it was predictable, there'd be billionaires that just traded currencies because it's so clear. So I don't know how to weaken the dollar. And I think even the Fed and the Treasury Secretary and investors really don't know what would cause a weaker dollar. We know that when we watch the yen, for instance, and the Bank of Japan, they've been desperately trying to manage the direction of that currency, as well as China. So I would instead rather look at the dollar movements against China and the dollar movements against the yen as just the state of the negotiating tactics between those countries. But I wouldn't be able to tell you what steps are needed to actually weaken a currency. I think Trump wants American businesses to make a lot of money so the stock market goes up. I don't think he necessarily cares what that means for the dollar. Commercial real estate is in really bad shape right now. It's because of many reasons. One is many people are working from home now, so there is office vacancies. And in many cities today, the quality of life in downtown areas has really worsened, which makes having employees in a downtown location less attractive. So it's in rarely rough shape. But commercial real estate is not what I call a short cycle asset. It's a long-term asset, and the money that is funding commercial real estate is long-term. Do I think in the long term commercial real estate is going to be this bad in 5 years or 10 years? I don't think so. I think commercial real estate is going to recover. Just remember in 2008, how many people told you never to buy a house again in America when home prices fell 40%? If you were enterprising and you bought homes in 2008, many people became billionaires because they were patient and found locations where home prices would recover. So I think if you're really skilled in real estate and can take the time and find opportunities, it's a great place. My expertise is not in commercial real estate, but I can tell you I've seen real estate transactions at 90% less than they were 2 years ago, okay? I don't think the second owner is going to lose money on that transaction. As they say famously, the second owner of a hotel always makes money.
Thank you very much.
Thank you. Markets tend to do the opposite. So because most people think we're down next year, I think the probabilities favor us doing better than what most people expect. The S&P 500 will rally strongly to 7,000 by the middle of next year, but the second half could be more challenging. Now you wonder if this is true, why do we think the stock market does well in the first half but does poorly in the second half? And that's because we looked at all those instances of when the market was producing 2 back-to-back years of 20% gains. That's happened 5 times since 1871. And 4 of the 5 times, equities actually declined in the third year, meaning 2025. The second theme I want to highlight is Bitcoin. I think it's going to get to at least 250,000 next year, but I think that's a low forecast. It could do significantly better. Good afternoon. It's nice to see everybody here. I want to spend the next hour giving you our forecast for the S&P 500 in 2025. What's different about next year is that the stock market is trying to digest two 20% back-to-back years. And our base case at the moment is that the S&P 500 will rally strongly to 7,000 by the middle of next year. But the second half could be more challenging. And so we end at 6,600. I'm going to explain why this is only a base case. And I think that we can see some reasons why the second half could actually be much stronger. So I think of this as a forecast from now until June. And then when we get to June, we're going to revisit whether or not the market could do even better. So our basic thesis is you have many tailwinds building next year. The first is the Federal Reserve has a put because inflation is cooling, and now the Federal Reserve wants to support economic growth and employment. The second tailwind is that we have a new president and what we call a Trump put. He is the most stock market focused president ever, and he wants to boost confidence from business leaders and boost stock prices. And what we think that is going to happen is that there's going to be a tremendous amount of cash taken out of bonds and risk-free investments into equities. Now you wonder, if this is true, why do we think the stock market does well in the first half but does poorly in the second half? And that's because we looked at all those instances of when the market was producing two back-to-back years of 20% gains. That's happened 5 times since 1871. And 4 of the 5 times, equities actually declined in the third year, meaning 2025. I don't think that that's going to be the case in 2025. But keep in mind, 5 of the 5 times, the stock market did better in the first half than the second half. So I am optimistic about next year, even though history says there's only a 1 in 5 chance the market is higher in 2025. So this is something we hear from many of our clients. They're saying that 2025 should be very tough or a down year because we had 2 back-to-back years of 20%. Whenever we believe clients believe something is true, that's what we call a consensus view. Markets tend to do the opposite. So because most people think we're down next year, I think the probabilities favor us doing better than what most people expect. But with that as the backdrop, this is our rough roadmap. We see the S&P rising strongly, that's 1,000 points through June. And then some sort of decline takes place, taking us maybe to 5,500 before we rally to 6,600 again. Now, when this happens, you have to be ready to buy that dip. These are the 5 instances I mentioned. There are 5 times where the S&P had back-to-back gains of 20%. 1880, 1928, 1936, 1955, and 1996. Here's what's interesting. If we look at the 3-year gains that were leading to that 20% back-to-back, the average gain is 75%. From 2021 to 2024, the gain was only 26%. This is why I'm optimistic. We have not overshot compared to previous periods when markets produce these strong gains. And in fact, if you look at this table, there's one instance where the market didn't have strong gains through the third year. You see 1996 when you were up only 59%, and we're up only 26%. Look what happened in the third year. The market was up 31%. So you can see there's actually some really wide outcomes. Down 39% or up 31%. And this is a very messy chart, but I put all this together. This red line represents those 5 years combined, and you can see up 75%. A strong first half, and then a decline in the second half. This blue line represents us today, up only 27%. That's why I think we're eventually going to catch up to this red line. I just don't know if that catch-up happens this year, 2025. And here are all the years that I mentioned, and the blue line compares us to today. But what do I notice? I shaded in red the second half of every year, and you could see that the stock market did better in the first half than the second half. So that's why, for now, I'm going to say in 2025, I'm more confident about the first half. But I'm not necessarily bearish on the second half. I want to see how we do in the first half. Well, not only should what we view as the market forecast matter, I think it's important to think about themes or investment ideas for 2025. And I want to highlight what I think are the most important themes. The first one is that we believe DOGE will be very effective. Now, you might not know what DOGE is. DOGE is an acronym, the Department of Government Efficiency. It's a newly created department whose sole function is to try to find ways for the US government to spend less money. And this is going to be led by Elon Musk, who is very famous, and Vivek Ramaswamy. The second theme I want to highlight is Bitcoin. I think it's going to get to at least 250,000 next year, but I think that's a low forecast. It could do significantly better. The third is what I call animal spirits returns. Now, this may not sound very familiar to you, but it's a very common word that's used in U.S. equities. When people talk about animal spirits, they're referring to a statement made by Milton Friedman, which is that economies boom when companies have animal spirits. What he means by that is when they have confidence. And it's this new administration, the Trump presidency, that is giving companies a lot of confidence. And the fourth thing I want to highlight is that we think a lot of our existing themes that we've highlighted for our clients become even stronger next year. And this leads us to stock picking. Stock picking has done very well the last couple of years, but it's been mainly a result of picking the large Mag 7, NVIDIA, Tesla, Google, Meta, Netflix, etc. We think in 2025, stock picking is going to lead to many other names outperforming. And the opportunity, therefore, is for investors to find some of these names and see some very strong returns. Actually, I'm going to highlight this chart. You might wonder, what could go wrong? And I think that there's a positive wrong and there's a negative wrong. The negative wrong, meaning the risk to the stock market, I think, is actually going to be policy. We asked both our hedge fund clients, which is FundStrat, and our retail clients, FS Insight, what they saw as the biggest risk to markets in 2025. And as you can see, 57% of hedge funds said it was Trump tariffs or deportations, and 43% of FS Insight. Investors believe the biggest risk to markets comes from the Trump presidency itself. And that's what you should just keep in the back of your mind, that outside of policy from the White House, the other risks are much smaller to markets. You may wonder on valuation, how do we get to 7,000 for the S&P? We believe earnings will reach $300 in 2026. That's 18 months from now. The stock market at the end of next year is going to be priced off of 2026 earnings. And we expect the PE multiple to get to 23 times by the middle of the year, and then get to 22 times by the end of 2025. The current PE is 21 times. So we're expecting the PE to go up by 1 multiple point. All right, so let me tell you about our favorite sectors for next year. Let's start by looking at what we've recommended over time. In 2021, the S&P was up 27%, and we recommended investors buy consumer stocks, energy, and industrials. And by the way, energy outperformed, rose almost 40% that year. In 2022, the market was down 20%, but our top sector pick was energy, and energy was up 59%. So even though the market was down in 2022, we identified the best performing sector at the start of that year. So energy outperformed by almost 80%. In 2023, the S&P was up 24%. But at the time, we had said that technology should lead and that FANG could be up 50%. And as you can see in that year, technology outperformed, was up 57%. This year, the S&P is up 27%. At the start of the year, our number one sector pick was financials. And as you can see, financials outperformed the S&P. In fact, financials are outperforming the NASDAQ this year. In 2025, our top sector picks are financials, again, so that's our number one sector, small caps, and also Bitcoin. So I would say our top calls, and we've had this call for some time, is that you want to overweight financials, small caps, and Bitcoin in 2025. This is very similar to the view from our other research teams. Our technical strategist is Mark Newton, and his favorite sector next year is industrials and tech and financials. And our quantitative strategist sees tech, financials, and utilities. So we are in agreement that financials, tech, and industrial should outperform. Okay, I feel like I should spend a few minutes talking about DOGE because it's not very familiar to our US clients, and I'm going to assume it's not very familiar to many of the folks in this audience. This is a newly created department, as I mentioned, and there's two heads, Vivek Ramaswamy and Elon Musk. This department actually has no executive powers. That means that they can develop recommendations, but nobody has to take their recommendations. Now, you may be skeptical because you're going to say, well, here's a government department that has no powers. How could that be effective? Well, this happened in World War II. In World War II, there was something called the Truman Committee, and Harry Truman was a senator in World War II. I don't expect many of you to be familiar with Harry Truman and the Truman Committee, so I want to explain what happened. At the start of World War II, the US government did not have the financial capability to pay for World War II because the US had just had some prosperity but was still suffering from the Great Depression. And at the start of World War II, US companies were taking advantage of the US government and overcharging or even sending defective products overseas. So Truman formed a committee. He made it a bipartisan committee, meaning there were both Republicans and Democrats, and it was made of people that he trusted. So these are the 7 members. He had no powers, executive powers, but he had the public. So he made a regular appearance on CBS radio. At the time, that was a national audience. And he would talk about the progress of his committee. He also asked citizens to send letters, and that was the starting point for its investigation. Now, this is interesting to me because this is very similar to Twitter. Elon Musk communicates to the US and the world through Twitter, and Twitter is one of the most powerful and most widely used communities today. So Harry Truman was the original DOGE. Okay. How effective was DOGE? Well, it was a smashing success. In fact, it was so successful, he was on the cover of Time magazine. I've listed some examples. He was so good, they called him an Investigator Truman, and that was actually one of his biggest accomplishments in his entire life. Even in some ways, he said more important than his being president. He found contractors were overcharging the US. He found Carnegie Steel was settling faulty slabs for ships, and they falsified quality control reports. He found Curtiss Wright was selling defective engines, and planes were crashing. Standard Oil and Alcoa were dragging their feet to find substitutes just to keep prices high. And he even found companies like Remington were basically bribing advisors. In total, he saved $10 to $15 billion from the US budget for World War II. Now, this is just one committee, and you might say, well, $10 to $15 billion, is that a lot of money? In 2024 dollars, that's $2 trillion. So just by his investigating wartime spending, he found $2 trillion of savings. Well, I think Elon Musk can do even better than that. I think there's going to be a very big positive surprise from DOGE because he will use Twitter to embarrass companies. You can follow what's happening if you have Twitter by going to this web's Twitter handle, DOGE, the Department of Government Efficiency. Today, the US spends $6 trillion a year, and they only take revenues of $4.5 trillion. So the annual difference is $1.7 trillion. So if he finds $2 trillion of savings, this will actually fix the US government deficit problem. And I think that would be one of the biggest positive surprises for the stock market. Now, many people will tell you this is impossible, because that's what our clients tell us. They tell us that, well, there's all this money that the defense industry spends. You can't touch that. And they'll say that the health care and what they call entitlements like Social Security and benefits can't be touched. But I'm going to disagree. I think that there are many abuses in what we call procurement. There's needless spending. The US overpays for many products, and there's a lot of waste. So I think that the surprise will be that we may uncover quite a lot of corruption. Now, this is negative in our view for healthcare. So if you own healthcare and you think you like healthcare, you probably are correct to own it long term. But you have two headwinds in healthcare right now. The first is RFK is going to be appointed the head of Health and Human Services. He is notoriously anti-healthcare, and I think it's the most important agency putting negative pressure on the industry. And now I think DOGE is going to find a lot of abuses in the healthcare industry. So you have two major government agencies that are going to put pressure on the healthcare industry. I think it would be very tough for healthcare to work. It's also negative for government contractors because defense companies and consulting companies are big recipients of government spending. So I think you should be wary of those industries. But I think it's going to be positive for companies that produce productivity. And the most obvious one to us is Palantir. And I think it's positive for bond markets because if the bond market worries less about government deficits, that means lower interest rates, and lower interest rates is good for equities. Okay, now I want to talk about Bitcoin. We've recommended Bitcoin to our clients since 2017, so touching on 8 years. And we've recommended investors allocate at least 2% to crypto. We think Bitcoin can reach 250,000 next year. It's very simple. One is we're going through the halving cycle, and that's a supply contraction at a time when demand for Bitcoin is still strong. The second is that we have a much friendlier government landscape. Many of you who follow Bitcoin know that the US has been hostile to Bitcoin for the last 3 years. In fact, the US was essentially trying to wipe Bitcoin off and make it illegal to own in the US, but they were not successful. The Trump presidency is taking a very different view. Foremost, the US actually wants to create a strategic Bitcoin reserve. Trump was on CNBC Friday, and he reiterated his commitment to making Bitcoin a reserve asset. I don't know if many people have thought about how much Bitcoin the US might actually buy. Today, the US government owns $660 billion worth of gold. They carry that gold on their balance sheet at the original cost from 1971. So officially, the US owns $11 billion worth of gold. But of course, if they sold it today, it would be worth $660 billion. The US owns 200,000 Bitcoin today. And in order to establish a strategic reserve, they've talked about increasing that total holding to 1 million Bitcoin, or buying roughly 800,000 additional Bitcoin at a cost of about $80 billion. The US only has to sell 15% of its gold holdings to fund that purchase of Bitcoin. Well, this is what makes me think about this important chart. Today, the value of gold is $18 trillion. And the total value of Bitcoin is $2 trillion. If the US is going to hold a strategic reserve of Bitcoin, it should own at least 10% of its value of gold in Bitcoin. That's about $70 billion worth. That's why I think over time, we have to think about where Bitcoin is going. We've used this view for some time, but we believe Bitcoin replaces gold. I think many of you believe that too, because it's quite useful. And if that's the case, if Bitcoin had the same value as gold, it would be worth $950,000 today. And that's more than 10 times higher than the current price of Bitcoin. We think the price of gold will rise over time, and that means that Bitcoin probably gets closer to 2 million or more. Okay, so let me talk about animal spirits quickly. It really has to do with the Trump White House. He's been welcomed by US equity investors because Trump is a second-term president, but this time entering the White House with the ability to create a completely new cabinet. That's very different if you think about it. Most presidents in the United States, when they have a second term, have an existing cabinet that they have to reconfigure. This time he's building that cabinet from scratch, and he's picked some really savvy people. And what Trump has said, he wants low deficits, he wants strong economic growth, and he wants lots of drilling for oil. That's going to keep inflation low. That's why many people, including Professor Jeremy Siegel, said that Trump is the most stock market focused president in history. And if we look at stock market returns since 1900, whenever there's been a Republican president, Republican Senate, and a Republican House, that's happened 30 times. Stock market returns have been around 8% with low inflation. Compared to a Democratic sweep, the returns are similar. But do you see how much more inflation there is when you have Democrats in power? 5% versus 0.5%. So again, I think it's going to be possible for Trump to deliver on his promises. We also have what I would call a dovish Fed. And I believe most people know what that means, but just to reiterate, a dovish Fed means the Fed wants to keep interest rates low and support the economy. And that's bullish for stocks as well. There has been a recession in the US in auto sales, in durable goods, and in housing because the Fed has kept interest rates so high. These benefits of lower interest rates are going to reverse this all next year. Okay, so that gets us to why are we recommending small caps and financials and Bitcoin? Well, it has to do with thinking of those two scenarios. We had written for some time that if Trump wins, it's positive for Bitcoin, positive for small caps of deregulation, and M&A, which benefits small caps and financials. And if the Fed is dovish, that's easy money, and that's positive for Bitcoin and small caps, as well as for the banks. So there's a lot of logical reasons for why we're saying that these are the best sectors in 2025. Now, that doesn't mean we don't like technology or we don't like the Mag 7, but these are catalysts for these groups specifically. Okay. This week, on Wednesday, the Federal Reserve is going to have its December rate decision, and they're expected to cut interest rates in December by 25 basis points. But we want to know what the Federal Reserve might do in 2025. Here is our take. We think it's better if the Federal Reserve does fewer interest rate cuts next year. The market is pricing in 3 cuts, but we think it's better if they do only 1 cut. I don't know how many cuts they'll do, but we know the Fed has to get to neutral. Neutral is the interest rate that they believe does not create inflation in the economy. The current Fed funds rate is 4.75%, and the neutral rate is believed to be somewhere between 2.5 and 3%. That means the Fed has to make 6 to 8 cuts to get to neutral. This is why I think 1 cut is positive, because if they only do 1 cut next year, they still have to do 5 to 7 cuts to get to neutral. So the fewer cuts they do, the longer the easing cycle is. And the longer the easing cycle, the longer the bull market. Because we know one reason bull markets end is when the Fed turns hawkish or begins to tighten rates. Okay, I'm going to spend just a couple minutes talking about longevity in America. That's a theme that we've talked about with millennials. But one thing that may surprise you is that millennials are a generation of Americans born between 1980 and 2000. These are the generations in America. There's millennials. There's Gen X, those born between 1965 and 1980. There's baby boomers born between 1946 and 64. And there's the silent generation, born between 1928 and 1945. The blue line here represents millennials. And this is from the BLS. It shows that at every age, okay, let's say at age 20 to 29, millennials, 28% of millennials were obese. And if you look at ages 30 to 39, when each of these generations was ages 30 to 39, almost 40% of the millennials are obese. And they now project that when millennials are between 40 and 50, 44% will be obese. So millennials are the heaviest generation of Americans ever. And this is why we think longevity will include weight loss programs and drugs to treat millennials. This is a long-term opportunity for investors. Now, let me spend a few minutes, because I only have 10 minutes left, to talk about small caps. Small caps are very cyclical. And in the last 10 years, small caps underperformed the S&P by 9,100 basis points, or 91%. Since 1800, this is the second worst 10-year period. The only 10-year period that was worse was 1988 to 1998. And then the second worst period before that was 1981 to 1991. And then before that, 1955. Here's the thing. What did small caps do over the next 3 years and 5 years? Well, in 1955, 1991, and in 1998, small caps outperformed over the next 3 years and 5 years relative to the S&P. So if you believe history is different, this won't happen. But in our view, the conditions are in place for small caps to outperform. And as again, I've mentioned, one of the principal reasons is that we have a White House that is going to push for deregulation, which will lead to mergers, and that's positive for small caps. The second is valuation. Small caps trade at an attractive multiple relative to large caps. Right here, you can see the median PE for small caps is 10 times forward earnings compared to 18 times for large caps. Okay, now we like regional banks as well, which are part of the financials. But here's, I think, an important chart for financials. This is stocks from 1933, and this blue line measures financials relative to the broader stock index. And you could see, historically, it was very cyclical. And then in 2008, the financial crisis happened. Now, after the financial crisis in 2008, the Obama administration took very punitive actions against the banks. And as you can see, banks struggled here since 2008. And then COVID happened and banks collapsed. So banks here are now below a level where they normally start to outperform the market. And again, we now have a White House that is pro-deregulation, wants to have the stock market do well. All of those require the financial industry to perform. So I think that this is the start of a period of outperformance of financials. And that's why it's our #1 pick. Okay, then let me talk about granny shots. My partner John Bay mentioned granny shots, and you may not be familiar with even what it means to have a granny shot. The granny shot refers to an unconventional way to throw a free throw in basketball. Most people shoot free throws overhanded, like Shaquille O'Neal, but those pro basketball players only score 52% of their free throws doing it overhand. But a more unconventional approach is an underhanded shot called a granny shot, where you throw the ball between your legs. But by that approach, you make 90% of your free throws. So even though it doesn't look sexy, it is actually the better way to shoot a free throw. And that's what we do with our granny shots. We try to find stocks that have a high probability of outperforming. How do we do that? Well, we have all these themes here. things I've talked about: energy and cybersecurity, millennials, the global labor supply shortage, the Fed easing, and we have things like style tilt and seasonality. And then we say, what stocks appear most commonly in these themes? And as you can see, in our small cap granny, the number one stock here is MicroStrategy because it appears in 4 themes. And also under this, these are the SMID grannies listed by how often they appear in one of these themes. Well, Granny Shots has done very well this year. This is how much better it did than the S&P. So the S&P is up 27% this year. The small cap granny shot is up 51%. But we also have a large cap granny. But we moved our large cap granny shots to the ETF granny, GRNY, which you can purchase on many brokerage platforms. And granny, the large cap granny has gained 5.5% since we launched it, and that has outperformed the S&P, which has only gained 2.88%. So its outperformance is 262 basis points. That is the end of my presentation. The first question you had related to small caps and how it may relate to Korean stocks. I think next year investors globally are going to be buying more financials and industrial stocks because technology and healthcare were the leading sectors in the US. But they're not as attractive next year. So I think Korean banks and industrials could benefit. Your second question about stop losses and trading, that's not exactly what we guide our investors for. But I will say, when our professional money managers trade, they always use stop losses because it allows you to have discipline. Because many times you might have a strong idea, but the market will move against you. And so you need to have a discipline to say, the market knows something I don't know, and that's why you get stopped out. But when you have hypervolatile situations like Bitcoin, I think you should not use stop losses because hypervolatile assets are known to have stops, and market makers will basically try to exploit those stop losses and trigger cascades. So you should be careful. The third question was, what do foreign investors think about the Korean stock market? I've heard many Korean investors talk about Korea for years because the valuations are always attractive. And there's many companies that trade below cash. They're called net stocks because the cash is worth more than the stock price. But I think American investors struggle with understanding accounting standards and financial reporting standards. So more Americans tend to buy the ETF. And of course, when they buy an ETF, they're buying market cap exposure, which means they're mainly buying Samsung. And of course, some Korean tech companies and consumer stocks. There is two kinds of money sitting in cash. There's short-term cash, which is mainly money market funds or even one-year CDs. And then there's longer-term bonds. The money sitting in money market cash today is $7 trillion. That was less than 3.6 trillion 4 years ago. So in the last 4 years, the amount of cash in money markets has gone from 3.6 to 7 trillion. That's because investors thought earning 5% was attractive. That's where federal fund rates were set. But as the Fed cuts rates, that is earning less cash now. In terms of bond allocations, so beyond 1 year, many Americans turned very pessimistic in 2022 because they saw a rise in inflation and a Fed raising rates, and they saw the stock market go up. So they were sitting in bonds because they thought we'd have a collapse of the economy. But instead, the last 2 years, the S&P 500 is up more than 50%. If the market doesn't go down next year, that money has to come out of bonds, because the S&P rising 50% in 2 years is like 15 years of gains in the bond market. It's very expensive not to own stocks. And in fact, many of our US clients think the S&P 500 can't do well next year. As I was writing my outlook, I kept hearing from our clients saying that the stock market should do poorly next year. And even since we published our report, everyone has nearly said the same thing, that the S&P probably doesn't do well next year. This is why I'm starting to think maybe it does really, really well next year, because everyone expects it to do poorly. If you're going to find a market that does well outside the US, you need to find a country where DOGE might exist. You know, can there be change? And where there could be corporate animal spirits. Maybe Argentina, maybe China, right? But you have a lot more risk when you look at those two countries. Well, Argentina less so. But China is risky because people have been fooled many times. That's why I think it's safer to buy Bitcoin or small caps, because even though small caps are in the US, they haven't done as well. CrowdStrike is a leading cybersecurity provider. It's been a granny shot for several years because it's not only about cybersecurity, but they're also important in terms of helping companies with automation. Their product is unique because it's installed in the BIOS of a computer. So when you boot up a computer, you're already loading CrowdStrike software. The collapse over the summer was because of what looked like a flawed update pushed to all the computers. And it was a huge embarrassment for the company. And the stock fell 40%. We were very worried about it and thought about deleting it from granny shots. But then we realized it's probably unlikely that a company of this size would have mistakenly pushed out a BIOS update that would crash all computers. And we realized there was possibly a cybersecurity threat that they had to deal with by crashing all these computers. And that's why the stock has come back so sharply. I think many people understand that there was probably something that they had to push out to eliminate a threat by crashing all these computers. We recommend Bitcoin and other cryptocurrencies. Our head of digital strategy is Sean Farrell, and he believes 3 cryptos are core: Bitcoin, Ethereum, and Solana. During a bull run of crypto, altcoins can do much, much better than that. So those would be outside those 3. But those are trading strategies, and I would recommend you contact Sean Farrell for those recommendations. Stablecoins refer to cryptocurrencies that try to follow a government currency or have less volatility than crypto. I think the best answer for me is a different way to answer it. People think that if we move to a crypto world, the dollar is less dominant, but that's the opposite. The most widely quoted pair for any crypto is USD, not euro or renminbi or won. So the dollar's dominance is even bigger in crypto. That's why the US has interest in crypto. People are worried that quantum computing might break Bitcoin's encryption. But that's theoretical, because if quantum computing can break encryption, it'll be easier to defeat traditional financial systems first. In other words, it'll be easier to defeat JP Morgan's encryption. The second is Bitcoin has something called the difficulty adjustment. If quantum computing can solve the encryption puzzles faster, the difficulty level will adjust automatically. But that means all miners will have to use quantum encryption. So quantum is promising. Tesla is one of the most important companies in the world. And I think it's in the process of being re-rated to reflect its lead in both AI and autonomous driving. Tesla, for many years, was popular with retail investors, but institutions were skeptical because they saw this as a car company. But Tesla is now doing many other things besides making cars. There's robots, and of course there's connected businesses like SpaceX and Neuralink, and there's the Boring Company. And all of these are businesses that are essentially harmonizing a lot of the efforts of Tesla. So to us, it still makes a lot of sense to own. And it's been a granny shot since 2019. When people are close to retirement, one thing they have to be aware of is they're going to live longer than they expect. When the US originally established the retirement age for Social Security, they assumed people would only live 7 years after retirement. Now most people who retire will live for 30 years. And in 20 years, those people who retire might live to 100 years. So people might spend 40 years or more in retirement. They face a lot of risk if they only have bonds, because inflation could rise or the currency could collapse. That's happened famously to people in many countries. This is why retirement recommendations will probably show more allocation to equity and cryptocurrencies. And BlackRock even now recommends 2 to 3% for every portfolio. And believe it or not, pension funds have been decreasing their stock allocations, but their funding deficits are becoming bigger. So we think pensions in the US are going to increase their allocation to stocks over the next few years. And I think individuals should follow that as well. In 2025, we talk about how space and aviation could benefit from DOGE, which is what you're talking about. Stocks like Archer Aviation or rockets could be very attractive next year because these are private sector solutions to government spending that was misallocated. And let me explain. Prior to 2010, almost all space travel and spending was done by the government. But SpaceX has revolutionized how the private sector is involved with space. And now drones and the drone makers are making better equipment than traditional defense companies. So there are many opportunities there. Lilly and Novo revolutionized what they call GLP-1, GLP drugs. And now they're finding these drugs treat addiction and a lot of other problems. But there are also many peptide companies that are developing new drugs. And this means there'll be more options and lower prices, and even other ways to get it delivered instead of injections. So I think you should just watch the space carefully because there will be opportunities. There's a lot of spending that is directed towards AI, and all these AI companies have to continue to raise a lot of money, and they're going to consume a lot of power, and every business has to have an AI strategy. So I think it's still going to be relevant as a sector. But in 2025, we think that many of the applications is where there could be some innovation. So it's probably more software versus hardware. The other thing to keep in mind is AI is creating a lot of dilemmas for businesses. You're seeing, for instance, both Elon Musk and Mark Zuckerberg protest OpenAI becoming a for-profit company because AI without ethical boundaries is quite dangerous. And I think that's what we could be seeing next year, is that outside the US, the AI capabilities are improving, but without ethical boundaries. And so there may be efforts in 2025 to create guardrails or protections or even limits of capabilities. And again, that's a benefit for software providers. Most importantly, nobody knows what will happen next year. Okay. We are just giving you a probabilistic look. And that's what you have to know when you invest. Nobody knows the future. It's more important to react to changes in conditions. The reason we think the second half is down is that's what history has shown happens. But if the first half is much stronger, and in the next 6 months, there could be many fundamental changes, that could negate all of our second half views. Stocks don't trade only on earnings. This cycle we predict or forecast will last through 2035. So that's why we're bullish on technology. The real winner are going to be companies that can drastically change their business models because of AI. Bitcoin has now been around for 15 years, and there has not been a Bitcoin 2.0. Bitcoin is the surviving chain. We recommended Bitcoin originally when it was around 1,000. People said, oh, it's a Ponzi scheme, and Bitcoin has become a $2 trillion asset. Mechanically, there's a lot of cash on the sidelines. There's a lot of firepower. It's always just important to buy the best companies wherever they are in the world. And when it comes to technology or financials or healthcare, the best companies are in America. Two things, it's always important to pursue things that you're interested in. But second, it's important to be lucky.
Good morning, everyone. I'm pretty excited to introduce Tom Lee, who is one of the most influential strategists on Wall Street. He has been a tech top rank analyst and strategist for many, many years. Tom is currently a managing partner and head of research at Fundstrat. So, Tom, welcome to Korea and welcome to Samfuro Live Studio.
Thank you.
And how's your trip been so far?
Well, it's been very short, but it's been very busy and very fun. We had some great meetings and some nice food.
Okay, that's good to know. And your next stop, are you flying to any other Asian cities?
Yes, we're traveling to Tokyo tonight,
Okay.
and we are going to spend a couple days there visiting our very large Japanese partner. And then I fly back home Wednesday.
Okay, for Christmas.
Yes, I don't want to get stuck at the airport, so I'm trying to get back early.
So, is there a large Japanese investor into the U.S. market? You know, whether it's Tokyo or Osaka.
Yes, it's grown a lot.
Okay.
The Japanese investor is much older, generally speaking, and they have quite a lot of savings. 10 years ago, they principally owned bonds.
Sure.
But over the last 10 years, we found that Japanese investors have become a lot more sophisticated. Many of them have bought growth stocks in the U.S., very large owners of what they call the Mag 7. And so they enjoy hearing updates about the U.S. market.
Okay, so you're doing a tour of Korea and Japan this time.
Yes.
Okay. Well, I mean, you probably heard about Korean retail putting a lot of money in the U.S. market. Very recently, in December, we had a lot of volatility in Korea. You've heard about the political situation. The inflow into U.S. equity from Korean retail has been $1 billion per day. That's
Wow.
pretty amazing, right?
Yeah.
So Koreans love U.S. equity. So can you just tell us a little bit about your background and about your firm? I mean, I have been a big fan of Tom Lee. Your full name is Thomas Chung Lee, right?
Yes.
Yeah. So a little bit about your background for an audience who may not be too familiar.
I've been on Wall Street doing stock research for more than 34 years. So I started in 1993. I graduated from Wharton.
That's a good school.
Yes, it's the undergraduate business school of the University of Pennsylvania. And my first job was at Kidder Peabody, which was one of the boutique Wall Street investment firms.
Yeah.
And I originally was focused on the wireless industry
Okay.
from 1994 to 2007. So most of my career really was spent studying technology and really wireless as an emerging technology. There were only 34 million cell phone users around the world in 1994. There's almost 7 billion today. I learned a lot during those 14, 15 years, mainly that stocks don't trade only on earnings because wireless
Definitely.
companies didn't generate profits. A lot of times there's balance sheet assets or future value. I also learned a lot about how important credit was to how stocks behave. Once the bond market loses confidence, there's no thesis for a stock.
The smart analysts look at entire capital structure, right?
Yes.
Yeah.
Yeah, our sort of adage, or what we have a saying, is that stocks are the junior piece of the capital structure.
Okay.
And I moved to JP Morgan in 99. I actually had 3 jobs at one point at JP Morgan. I was the head of wireless research, the head of small cap strategy, and the head of strategy.
Wow.
But in 2014, I left to start Fundstrat
Okay. Together with John.
with John Bay.
John Bay.
And so this is our 10th year as an independent research firm. We originally built the firm around the idea of really providing institutional quality research to a much bigger audience. When I was at JP Morgan, I principally served only hedge fund clients.
Yeah. Who pays the bill?
Yeah, they pay large fees, but we found that many people wanted to access some of the things we were saying. So we really wanted to democratize that process.
Sure.
And I think we've been largely successful.
Okay. So Fundstrat is an independent research house catering to both institutions and individuals and any clients.
Yes.
Yeah.
And we've got a wide reach now. We have clients in over 30 countries.
Wow.
And about 10,000 family office and RIA clients.
That's very impressive. 10,000 family
Yeah,
offices.
so we're one of the largest independent firms actually now. And we just started an asset management business called Fundstrat Capital.
Okay.
And we launched an ETF called Granny Shots. And that actually is now considered one of the biggest launches of an active equity ETF in more than 15 years.
Wow, is that right?
Yeah, in about 5 weeks, it's attracted over 620 million of assets.
Wow. What's the ticker code?
GRNY.
GRNY.
Yeah.
Okay. So we'll follow that.
Yeah.
Okay. I mean, we're going to talk about the market, your prediction. I know you've been pretty spot on for 23, 24, very impressive. But we in Korea, we're just learning the U.S. equity. I mean, I used to work at JP Morgan like you did many years ago, but most of us were pretty, green in terms of investing in the U.S. But we want to know about your thought process and how do you generate ideas? Is there any wisdom that you could share with the Korean audience?
I'd be glad to. Our process is fairly simple. Foremost, when we think about markets in any period of time, we take into account what we generally think is the economic outlook.
Okay.
And one thing I think people miss, and those who are bearish, is that companies have been far more resilient than people expected.
Particularly in the U.S., I guess, right?
Yeah, especially in the U.S. Because in the last 4 years, we had a pandemic that shut down the economy. Then we had a big supply chain shock that created a big inflation wave. Then we had the Federal Reserve raise interest rates at the fastest pace in history.
That's true.
And then we had a very controversial election. Yet in these 4 years, companies produced really good profits.
Yeah.
So I think we generally look at what we expect the economy to do, and it's been strong. And there isn't a lot of leverage. But then we also realize that U.S. companies have proven to be very strong. So that's our first part of the process.
So you take some view on the macro, you look at the balance sheet capital structure, and you look at the company's earnings.
Yeah, and we also look at, recently spent a lot of time on economic data, like inflation.
Okay.
So I think what really helped us the last 2 years was our bet that inflation was going to be a lot softer than consensus. And that kept us...
I know you've been quite aggressive in predicting inflation is going to be under control, right?
Yes. And, looking back, that was the right call.
Okay.
Because the Fed has been cutting rates now.
Sure.
And in the face of many people who thought the Fed had to create a recession. I think the second part of our work is really thinking about what are the important drivers of sort of surprise. We call these thematic models.
Yeah.
One that we'd been talking about for a long time was the global labor shortage.
Okay.
Since 2018. And we thought that would drive a wave of AI spending.
Okay.
And that's because this global labor shortage happened twice in history. 1947 to 1954 and 1991 to 1999.
I didn't know after World War II there was a shortage. Okay.
Yes. Well, in World War II, the shortage was because of the mortality from all the
that
fighting.
makes sense.
There was a global labor shortage of prime age workers. Both times technology stocks outperformed. So this cycle we predict or forecast will last through 2035. So that's why we're bullish on technology. Another theme that we spend a lot of time thinking about is what we call impact of generations.
Okay.
And it's really the millennial.
Okay.
They're both the largest generation in the U.S. in history, but also set to become the wealthiest because of wealth transfer. And so we spend a lot of time modeling that impact on the economy.
Okay.
And then, of course, the third is really what I'd call digital transformation and security, energy security. And that led us to Bitcoin pretty early.
Okay.
We've been writing about Bitcoin for the last 8 years.
Yeah.
So that helps us determine what kind of stocks we are looking for.
Okay.
And then we also think about positioning.
Okay.
So we survey our clients. We find out where they generally stand with their sentiment and their positioning. And we look at margin data to see how much capital has been exhausted. And that helps us to be more tactical. So I'd say our process is straightforward.
And
Very transparent.
How do you use consensus data? Like Michael Hartness, Bank of America, is my colleague. He published this a survey, which is even quite widely quoted in Korea. Do you use it as a contrarian indicator, or it depends?
It depends. I don't see other firms' research. So we're not...
You don't?
No, we don't.
Okay.
And that's because I want to avoid groupthink.
Okay.
Or what they call echo chambers.
Sure.
Even when I was at JP Morgan, I rarely looked at what anyone else published. But anything that surveys clients and shows a complete view of their positioning, it's actually useful. So I'm assuming Bank of America has good data. But I don't think it's necessarily led to different conclusions than what we've seen from our own client surveys. Our universe of clients is large enough, because we have 300 hedge funds and 10,000 family offices, that's probably almost the same universe that would represent the market.
Sure. So you use these three thought process: the macro data, also the long-term thematics, and that's probably helps you to view the market from a top down, and then use consensus data to take a certain position.
Yes.
Okay.
But I think the thematics is important, because most investors can be lost otherwise. I can't tell you how many people said that they don't want to buy Tesla because it's expensive.
Koreans, we own 2% of Tesla. You probably heard about that.
Yes, yeah. And many people don't want to touch NVIDIA because it's expensive. But when they consider the transformation that's coming from AI, then these are quite attractive stocks. So it helps us anchor our longer term views.
Okay. Well, I mean, since we are on a topic of the digital transformation, I mean, in the AI, people worry, and I think the market has been closely following the comments by the CEOs, and also whether the companies will generate return on invested capital for the cloud companies and the big tech. Do you think this is a real, that eventually that we're gonna see the tangible results? So this will be a very sustainable theme.
Yes, AI, is a coming wave, and that's because it's a quantum improvement in the capability of a workforce, right? Over time, generative AI is going to produce a PhD level worker, and at an unknown cost today, but presumably with a drastic drop in cost, it'll be cheaper than hiring a human PhD. So it's a huge force multiplier. Along the way, I'm sure 90% of the capital will be wasted, but that happened during the internet build out, and it happened in the wireless build out. A lot of money was wasted. A lot of promising technologies basically fell flat. So kind of expect that to happen. So it's safe to be betting on what they call the arms merchants right now.
Okay. So it's a real thing. And what do you think is the best way to play the long-term AI theme? Is there an ETF or any group of stocks that you would recommend?
The market's pretty good at figuring this out. So I would say the Mag 7 are all in what I call primary position to benefit.
Yeah, that's true, yeah.
And we know that NVIDIA is got a vast lead over others. And we also know that there's going to be critical shortages of power and components. And so these aren't necessarily the best quality companies, but they're the ones that can deliver power and components quickly. So I think that that's the correct way to play this right now. But over time, the real winner are going to be companies that can drastically change their business models because of AI.
Yeah. I mean, Broadcom's market cap exceeded $1 trillion, I think, last Friday. That's pretty amazing.
Yeah.
Okay, so let's talk a little bit about the market. So if we look back this year, I think you made a pretty good call. In your view, what has worked very well, and what were some unexpected surprise?
Well, in 2024, I think the principal difference in our view versus the street was that we believed we were only in the second year of a recovery.
Okay.
So the Fed and their tightening cycle essentially created a rolling recession. You know, there was clearly a recession in housing and durable goods and auto sales. In any past cycle, that is a deep recession. And now the Fed is easing. So 2024, in our view, was really the second year of an expansion.
Okay.
Many people instead thought 2023 was the market getting ahead of itself and 2024 would be payback.
Okay.
But instead, we're doing even better this year.
Okay.
I don't think most investors still have accepted that, because when I hear folks talk about the economy, they think we're late cycle.
I mean, I just listened to Mike Wilson on, I think, YouTube, Bloomberg, and he was talking about late cycle. A lot of people.
Yeah, well, it's been a very expensive late cycle for people, you know, I think it's a disconnection from what people can really observe. You know, if someone talked to their neighbors the last few years, people have been cautious. That's usually not late cycle behavior.
Okay.
Companies have been cautious. The ISM has been depressed for 3 years.
Yeah, yeah.
That's not late cycle.
Okay.
So as these indicators turn, actually, the economy could actually accelerate.
Accelerate.
Yeah, and that's our base case right now.
I mean, my impression, correct me if I'm wrong, is, I mean, you use a lot of analysis and data, but a lot of your insight comes from your observation, from your experience. Watching what people say, how they behave.
I studied accounting in college. And I think what people have to remember is the financial model is trying to take an actual event and express it in an economic term. And I think what most people forget when they do analysis is they look at economic data and they don't align it to the actual event.
Okay.
And so people are essentially disconnected from reality.
Sure.
And this is already on display even just recently, because people talk about inflation picking up in the recent reports, but that's mainly due to the hurricanes.
Okay.
So they're causing shortages to cause prices to spike. And now I hear people saying inflation is accelerating again, but it's just the hurricane effects.
I know, I mean, reading some of the emails sent by Fundstrat, I mean, you take a very unique view, and that's like what you have talked about. Let's talk about 2025. I mean, what's your view on the market, if you could express in terms of S&P 500? I think it's currently 650, right? So including dividend yield, it's up nearly 30% this year, which is pretty amazing. And what are some of the assumptions you have in your forecast?
The S&P right now is around 6,000. And we think it's going to go to 7,000 by the middle of next year.
Okay, so by the middle of next year.
Yeah. And at the moment, it could change. But at the moment, we think the first half will be better than the second half.
So stronger first half. And
Yeah. And so the market could run out of steam in the second half.
Okay.
So consolidate. And so we end at 6,600.
Okay.
It's still 10% growth for the index.
Okay.
But
After 30% rally, that's pretty impressive, right?
Yes. But I think that that's maybe not as important as people to understand that what we're really saying is that after 2 years of 20% gains, the market probably gains again. Because most people think, well, if 2023 was so good and 2024 was so good, we can't have a good 2025.
Yeah. And the valuation is not cheap, right?
Well, you know, I think almost everyone we talk to talks about valuation. And so when people worry about valuation, it's probably less of a problem because everyone talks about it.
Yeah, okay.
Yeah.
So what are the key assumptions in your model predicting nice rally, continuation of the appreciation in the first half and some consolidation in the second half?
Yeah. Well, I think what we have to be mindful of is this is a framework. And I think too many investors think that this is a hard prediction. You know, like I don't think on June 30th, 7,000 Like we'll set the clock to that number.
Yeah.
And I think any discussion we have has to be aware that this is just a framework.
Yeah.
But what we're really saying is that there are probably room for more positive surprises in the first half because we have an incoming president that's very pro-business, probably the most pro-business president in modern times. And with so far the cabinet selections that the market is very happy with. So that should be providing room for investors to become optimistic, which they call animal spirits. And the second tailwind is the Fed is dovish. And what that means is the central bank is easing. So that's positive for stocks.
Okay.
The third is investors are cautious because almost everyone we talk to, including you, think that valuations are expensive, or because we've had 2 good years, next year has to be bad. So we know sentiment is cautious. Usually when people are cautious, then you bet against the caution.
I didn't say valuation expensive. It's not cheap. But anyway.
Yes, I'm not sure there's a difference, but and then the fourth is that we know mechanically there's a lot of cash on the sidelines.
Okay.
There's a lot of firepower. $7 trillion of cash on the sidelines. So I would see this as positive for the first half of next year.
Okay.
But it could be, maybe the S&P goes up to 7,500, right?
Okay.
I mean, I don't know. 7,000 is sort of just a guess.
Yeah. I mean, who knows, right?
Yes.
But what you're saying is that the momentum is still here. There will be a lot of positive surprises. A lot of the good news will be more reflected in the first half than the second half. Yeah.
Yes.
Okay.
And then the second half, it's more just looking at precedents because since 1870, there have been 5 previous instances where the major index had 2 years of 20% or more gains in a row.
Okay.
And 5 of the 5 times, the market did poorly in the second half.
Okay.
So we might make the gains in the first half. However, that is just history, so we could do a lot better than that.
Should we worry? I mean, obviously there has been a Powell put, right? So protecting some downside this year. Next year, if we get some positive economic growth, the Fed would be pretty slow or backloading the interest rate downward cycle. I mean, is that something to be aware of, or is that more, we should take it more positively?
Yeah, well, it's a very good point you're bringing up. The bond market is pricing in 3 cuts next year. So they're expecting the Fed to make 75 basis points worth of interest rate reductions. Now, the current Fed funds is 4.75%. And neutral, let's say, is 2.75. So that's actually 2 percentage points of easing the Fed has to do, which is about 8 cuts. The question that markets have to deal with is how many of those 8 cuts happen in 2025? So they expect 3, which leaves 5 left for the rest of the easing cycle. I think the best case is the Fed to only do 1 cut next year.
Okay.
Because that leaves 7 cuts in the future. Which gives them a lot of firepower. So I would prefer, but it's not a prediction, to see the Fed pause, and the market might initially get worried, but then they'll realize it's quite bullish.
But that's eventually a sign that economy is strong and there is no need to cut the interest rate.
Well, they have to cut because look at Fed funds versus the rest of the world. I mean, Europe is 150 basis points lower than the Fed. So, I mean, it's going to put a lot of pressure on other central banks if they don't do something.
What are the sectors, companies you like?
Well, our overweights for next year within the equity market, number 1 is financials.
Financials. It's been good rally past couple of months, right?
Yeah, and that's our number 1 sector. Number 2 is industrials.
Industrial.
And number 3 is technology.
Okay. So tech plus cyclicals.
Yeah.
Okay.
But we also like small caps.
Okay.
And Bitcoin. So if I had to say what is our number one ideas, it's really financials, small caps, and Bitcoin.
And can you give us reasons why you like, why you believe that financial will continue to run?
Well, financials have been suppressed because of what I'd call financial repression. The Fed's been tight, so they're easing, and the bank stocks have done poorly since the pandemic.
That's
so there's
true.
a big catch up there. The Trump administration is going to be pro deregulation and also reduce the barriers to mergers. That's capital markets activity. That's bullish for financials. And financials, of course, are pretty sensitive to overall economic activity picking up. So that's why we like financials.
Do you like the nomination of a Treasury Secretary Scott Benson? Do you think that's a positive sign for the market and for the economy?
You know, the best way for me to answer that is that markets really like him.
Okay.
So, you know, because again, it's interesting, but it's usually not as important what I think as much as what I think how the market's reacting. And the market's very happy with him as a Treasury Secretary.
Yeah, that's a good way to put it. How about industrial? Is it like a positive view on cyclicals?
Well, yes. It's because the ISM's been depressed for 3 years. And so if someone said the ISM manufacturing, the ISM is a widely followed index, Institute of Supply Management, and it's following what the purchasers in manufacturing are saying. And that's been below 50 for 3 years. Below 50 is basically contraction. If someone believes the ISM is going to get worse next year, industrials will do poorly. But if they believe that confidence is going to improve and manufacturing will expand, that's very bullish for industrials.
I was told that the recent survey among the small company CEO, the numbers have been pretty solid. Yeah.
Yes. Yeah, I think you're referring to the NFIB, Small Business Optimism Survey. That's a federation of small business owners. Small businesses represent 75% of all private employment. So it's a pretty important survey to watch. Most small businesses tend to vote Republican.
Okay.
So their optimism tends to go down when there's a Democratic president and it recovers when there's a Republican president.
Okay.
But as you can imagine, their optimism also actually is tied to capital spending. So I think small businesses will be more optimistic and actually expansionary.
And that's another reason why you like small caps.
Yes, that's right. Small caps have suffered because the market breadth hasn't been great.
Sure.
You know, 2024, we fortunately were recommending the MAG 7 or the FANGs. But if someone wasn't overweight FANGs, it hasn't been as good a year for markets.
And how about the MAG 7? I mean, correct me if I'm wrong, but in Japan, I heard Japanese investors want to express their views through the index ETF, so getting a more broader exposure. Korean investors, because I think the country is more geared to the tech, I think investors here like to play QQQ, NASDAQ, or individual MAG 7, thematic ETF, and quite often I'm pretty opposite, leverage ETF to the tech cycle.
Yeah. Well, I mean, I think tech is still a great space. Next year, they should do really well. Maybe more software. And the MAG 7, I think, can still have a great year. You know, maybe, produce good returns. But I would probably encourage investors to realize when market breadth is expanding, that means more stocks are going to rise. And market breadth has been rising.
Do you think Elon Musk's deep involvement in the next administration, would that continue to be a positive factor for the M7 or the big tech, or eventually it will turn out to be an ugly scenario?
I think it's very positive.
Is it? Okay.
Trump admires successful people. That's a good thing. You know, he really does respect people who've made a lot of money and created a lot of value. I think that it's very easy for the government to antagonize large businesses and successful companies. So this is really a historic opportunity for the U.S. government to partner with really the most successful companies, and then really tackle a bigger issue, which is government waste.
Yeah. So you're pretty positive about getting rid of all these fats at the government organization, helping to cut down the debt and the fiscal deficit.
Yeah, it takes a lot of bravery. I hope it happens, but it's of course very difficult.
Okay.
I think healthcare waste and government waste are very entrenched, and so it's very difficult to fix.
We talked. I mean, you mentioned about the thematics earlier. We talked a little bit about AI, the Bitcoin. I know you've been very positive for many years. So, what's the thought process here? I always wonder how can you value a Bitcoin? I mean, is that a stupid question?
Well, in reality, in this conversation, nothing I say will change a skeptic's mind. So, I don't know if that question is really that useful. I think that it's probably better to just observe a few things. One is Bitcoin has now been around for 15 years, and there has not been a Bitcoin 2.0. So there's no crypto 2.0. This is Bitcoin is the surviving chain. And Bitcoin has become a $2 trillion asset, which never in history, financial history, has anything reached $2 trillion and then disappeared. So it's a different argument if it was $100 billion.
Okay.
The third is the U.S. government is reiterated its commitment to make Bitcoin a strategic reserve asset. That's not bad for the price of Bitcoin. So if someone is watching this and said, well, they don't understand Bitcoin, so they decide not to own it, it's a catastrophic way to look at markets, because we recommended Bitcoin originally when it was around 1,000, and we recommended investors put 2%, and many people said they won't buy it until they understand it, and then we'd spend 2 years explaining to our clients why they should own some Bitcoin, and they still refuse to buy it. So I don't think, if someone is not going to buy Bitcoin until they understand it, they may end up missing one of the biggest opportunities in their lifetime.
Do you see more of your clients actually warming up to the idea and taking action?
I think many are just recognizing that they're being obtuse, in the sense that they're being stubborn to be skeptical of it. I can tell you, people had many arguments against it for years. People said, oh, it's a Ponzi scheme. It only goes up because of the creation of stable coins. Or people said that Bitcoin is going to go to zero one day. Or they're going to say that, well, why doesn't someone create a new Bitcoin? I would say that it's the same attitude people had for stocks since 2009. At JP Morgan, we had made the argument in 2009, and this really helped us become very well known among the institutional world, was that we had said in February of 2009 that a new bull market was starting, but one that we think could be quite significant, that could last for decades. And we had shown that the bear market that was taking place was actually in severity almost as bad as the Great Depression. Many investors were skeptical for years. If you recall, from 2009 to even 2014, people said that was just a fake bull market due to the Fed, and they thought we'd eventually go back to 600 on the S&P. Well, by 2015, many people lost their jobs because they fought a bull market that had almost tripled in price. I think that's what's happening now in crypto, because as much as people saying it's not a legitimate asset class, the fact that the U.S. government's about to buy it really changes the discussion.
So you recommend people to get some exposure?
Yes, at least 2%.
Okay. Let's talk a little bit about any tips you would have for the Sampuro audience and the Korean investors in general. I mean, it's been just 4 or 5 years that Koreans have started to really buy U.S. equity in a big way. I think the biggest dilemma for investors here, whether that includes the National Pension Service, that's a $1 trillion monster, or the institutions or the retail, is the Korean equity has been a dog in the OECD. I mean, even this year, we got a positive semiconductor cycle. Korean won is weak, but Kospi is down 6-7%, and it's bizarre. So really, retails are really wondering whether I should maintain any exposure to Korean equity because it's so cheap. It's 8 times earnings, 0.9 times book, or should I put 100% of my money into a one basket U.S. equity? I mean, what kind of recommendation would you have? I know probably there's not a simple answer.
And that's also not my area of focus. One thing I learned over my years is really focus on where we have sort of a knowledge base, and that's how we can serve clients. My focus really has been identifying the important themes within the U.S. stock market. So I don't have a view on Korea, but
I understand.
It's always just important to buy the best companies wherever they are in the world.
And you remain very positive about the U.S. equities and the quality names there over long term, right?
Yes, I think everyone should buy a stock that they understand. That helps them understand and to get good information flow.
Last question, just more about your personal aspect. So, Wharton is a great school. I know a lot of people go to the banking, finance, consulting. But what made you to start a career as a research analyst? And do you have any regret, or is there any area that I should have, if I have done even better if I pursued a different career?
Well, I was in Wharton in the 90s. Most of my peers wanted to become traders. Back then, the most desirable job on Wall Street was to either be a sales trader, to work on the trading desk, or to do investment banking. I didn't have interest in either. I found stocks and understanding valuation much more interesting to me.
Intellectually challenging, right?
Yes. Yeah. And so I wanted to get a career in stock research. So I didn't pursue a career for money, but it turns out I was very fortunate because that was the beginning of a really big cycle in research becoming one of the most important businesses on Wall Street. Today, research powers so many investment decisions, investment banking and in hedge funds and clients. So research is really one of the most important areas. In fact, sales and trading has been largely automated, and AI is of course trying to actually provide tools around research because it is the most important business. I think that's just a lesson to me that two things. It's always important to pursue things that you're interested in. I was always interested in research, but second, it's important to be lucky because it was a very lucky decision to do research.
I mean, just going back to the ETF, because I think the research is really understanding about the market and trying to find the value, intrinsic value for stocks, right? Which is not easy, right? But for your ETF, right? What's the ticker code?
GRNY.
GRNY. Okay, Granny, right?
Yes.
So, how do you come up with the stocks to be included in the ETF?
Well, the Granny Shots is a name that's very familiar to FundStrat clients because we've had a research stock list called Granny Shots for 6 years. It's called a Granny Shot because it's a way of shooting a free throw in basketball that's unconventional. It's underhanded, but it has a higher percentage rate of success. The Granny Shots looks at themes that we think are the most important to markets, and it finds the strongest stocks. And a Granny Shot is a stock that appears in more than one theme. We moved that Granny Shots portfolio to FundStrat Capital this year. So now it's only exclusively available for someone who's buying the ETF. So that research list is no longer available.
Is that right?
It's 35 stocks, so it's fairly concentrated. Since the launch on November 7th, it has returned about 5%.
Okay.
And the S&P has returned 2.2%.
Okay.
So it's outperformed the S&P pretty dramatically. And we have a lot of positive feedback on the Granny Shots ETF because we record a video every week explaining the holdings and what's impacting the return of the portfolio. So I think we've been very transparent, and I think that's why it's become very widely followed as an ETF product.
I mean, transparency and consistency are very important pillars of success, right?
Yeah.
Yeah. I mean, so you generate top-down ideas, thematics, and you got a people who choose individual names along the individual themes?
Well, actually, I'm the portfolio manager, so I make the stock selections.
Okay, okay.
But it's no different than what I've been doing for 6 years. I used to be an equity analyst, so I'm very familiar with understanding what are sort of dynamic qualities of a good business. So we do make sure these are high quality companies.
Okay.
But I think the differentiator is most portfolio managers don't communicate their decisions to the holders of the fund every week. And we actually record a separate video for Granny Shots every week.
So for our Korean audience or any international audience, what is the best way to listen to, follow Tom Lee's up-to-date ideas and thought?
Well, of course, we have a partnership with 3Pro TV, so I think
Okay.
they're going to receive quite a lot of content from there.
Okay, 삼프로, yes.
And if they want more information, they can, of course, become a subscriber.
Subscriber. Okay.
Yeah. But if they want to follow stocks, more stock specific, I would recommend that they subscribe to the Granny Shots website, and they can receive a weekly video explaining the holdings and why we're, for instance, in a recent video, we're talking about MicroStrategy and why it's a proxy for Bitcoin.
I know that stock also commonly talked about the investors in Korea as well.
Yes.
Okay. Okay, well, Tom, I mean, before we close, is there any, remark that you have for our audience?
Well, I think it's very encouraging to see Korean investors invest in the U.S. because it is the best market in the world. It's a story that we've been trying to explain to global investors for the last 10 years, that you really want to buy the best companies. And when it comes to technology or financials or healthcare, the best companies are in America.
That's true, yeah.
They're not the best industrials. You know, around the world, you're going to find many good industrials or very good luxury brands around the world. But when it comes to tech, financials, and healthcare, it's mainly the U.S.
Okay, Tom, thanks very much, and have a safe trip to Tokyo and a safe trip back to the U.S. for the Christmas. Thank you very much.
Thank you.
Okay.